Welcome to this family law software webinar. This is the 8th in our 9-power webinar series. Dates today, we're going to be talking about pensions, and I am recording this session. They will be up on our YouTube channel in a couple of days. We have a YouTube channel with all of the webinars from this series as well as other ones. So please feel free to check that out, subscribe so that you can get notifications as we put more up there. I'm Nancy Chaucer-Schaefer. I am an attorney in Illinois and your family law product expert today. Joining me is Anna Tate, who is also an attorney in Florida, and she'll be helping me with the Q&As, and hopefully I won't have any goofs that she'll have to correct. Okay, so let's talk about pension value. So pension, we're talking about defined benefit plans. That means it's a plan that will pay X amount per month at retirement. It doesn't have a cash value now. So remember that what we're calculating is a present value, which will be a mythical value. It's not real. It's not real dollars for either party, but it is a way to put a value on the plan so that you can potentially trade it off for other assets and so on. So the pension value relies on assumptions. So let's look at that. So I'm in the pension data entry screen, which I am entering through the analysis section. You can also go and enter data, assets and liabilities, and there will be a defined benefit plan, defined benefit pension listed as one of the assets, and you can put in the information there as well. It's the exact same data entry, the exact same results. So I'm just doing the shortcut for pension plans here. So now I've opened the little expand collapse arrow to see what we've got here. And we start out with some data, basic data, birth dates and gender for pension plans, because we're looking at mortality tables, which typically are gendered, or there are a couple that are gender neutral. There are no non-binary genders in pension valuation, at least yet. So we have to put in a gender for each party, or for the party with the pension. Okay, and then we have the description of the pension. That's what's going to show up on your reports, the pension plan name. And it's actually a good idea to check and make sure you know the name of the plan, because you want to make sure that, of course, your quadro has to be specific, the qualified domestic relations order, with the name of the plan. And you may as well make it correct in the marital settlement agreement and on all of your reports. So you want to make sure you have a good name for the plan. And then we're going to go into more information. Oh, wait, one more thing before I do that. You're going to see here, we've put in the retirement age and monthly benefit. That could be information that was already in the program for retirement age. And then we have two choices: use the software's value or use an outside valuation. So if you have an expert in your case, you can just use the outside valuation, put in the number, and you're done. But maybe you want to check it. Maybe you want to see if that valuation expert is a fair and honest broker of the value. So let's look at what the software does to value the plan. And this here is the calculated value based on the information we're going to put in. So now I'm going to go to more information. And this is, again, going to have the checkbox to have the software value a plan. If you don't want the software to value it, you would uncheck that box and go to the outside valuation. Okay, we have the description. Now we have the birth date of the plan owner. In this case, it's going to be Taylor's plan, and the gender. And that is for the mortality tables, as I told you. And then retirement date, okay, which is the benefit start date. So you're going to put in the age or the date at which they will retire, and the program will automatically fill in the other of those based on that date and the birth date. Okay, so the program does the math, we don't have to. And then you want to put in the proposed benefit amount. Generally speaking, you're going to have a statement from a plan administrator that's going to give you that information. And if we click on the help button here, it will tell you why we need that value and what we're going to do with that. Okay. Now, let's say you only have a plan estimate. You don't know what it's going to be. We actually have a really cool tool here, which I rarely use because generally speaking, I'm going to get something from the plan administrator with a value. But if we click on estimate, this is where there's going to be a number of years, percent of compensation, so on. And then the plan will figure out what that number is going to be. Based on, this is those plans that it's a percentage of income or number of years of service. So that's going to all be taken care of in this calculation. But generally speaking, I'm taking the number from the plan administrator. And then we have the interest rate. So up till now, we were dealing in essentially facts. Now we're dealing with projections and with assumptions, okay? So what is the interest rate? So if we click on the link for discount rate, you will see that we use a 20-year treasury bond rate. And that treasury bond rate we'll get to the curvature fraction in a minute. The treasury bond rate is what is considered to be a safe or conservative rate of return. You can use a different rate. Now, we update the rate monthly in the software, but when you open a file, that rate is going to end up getting fixed to the rate that it was when we last updated the program. The reason for that is if you had it constantly updating behind the scenes, then your numbers would keep changing, and you'd be sitting down with the client and the number would be 56,973. And then 2 months later, you'd sit down with them again and the number would be 57,942. So, they go crazy, you'd go crazy. So it's going to be fixed once you open a file. But what you can always do is change it. And we give you a nice link here to go out to the Federal Reserve daily rate table, and you can put in the rate, and we even tell you which one it should be. Okay. Or you can put any rate you want. Okay. Now, so that's your first big decision point where an actuary actuaries do these kind of evaluations are using their knowledge and skill. We're helping you with hints, and hopefully you will be able to do a good valuation, or at least a useful one. Now, the next item is again a fact. What's the COLA rate in the plan? A lot of government plans will have, and there aren't that many pensions anymore. Many of them are government plans, and they will often have a COLA rate of 1 or 2 or 3%. You can have it where there might be different rates, and you can click on this link to enter different values for the COLA. And then you can also make it a simple. So generally speaking, pension COLAs compound. So if it's 3% a year, if it was $1,000 benefit, then it would be $1,003, 1% COLA, and then it would be 1% of 1,003, and then it keep going. Okay. But if the plan is CalSTRS or some other simple COLA, then you would click the box here that I'm pointing to, and that would give you a simple interest rate. So I'm going to put in a 3% COLA, but we'll say it's simple, and you'll see that it will change the value. So right now the pension value is 74. If I take out the simple, now it's 79. If I change the COLA to a 2%, it goes down to 70. So there will always be a change anytime you change the data inputs here. And we get down to line 10, this is the pension value. So now you'll notice that I skipped over question 8, which is which mortality table to use in valuing the plan. This is, of course, the big assumption. The interest rate or discount rate, as we call it, is relatively simple. It's a financial calculation. We're used to seeing that in business valuations where there might be a discount rate. Mortality tables is a whole different animal, and there are multiple mortality tables. So for example, in Colorado, they use the Census Bureau table. Okay, most older cases might use a GAR 94 or the UP 94. Very few people use that one, but if you have a white collar client or opposing party, you may want to see what the value would be for that, which theoretically is more reflective of their mortality rates. White collar job holders tend to live longer than blue collar or unemployed. Okay, and then here we have little descriptions for each one. Okay, which will tell you what each of these mortality tables are. We don't expect you to become actuaries or to be that exact. And that's why I started out this discussion by saying these are mythical values because it will change based on the mortality table. So right now we have a pension value, and this is for 100% of the pension. That is 70,000. And if I change the mortality table, you're going to watch the pension value change with each one. That doesn't mean that one is right or wrong. There are some that are probably more appropriate than others, but this will give you a range of values, which is really more important than one number. So it's, I think, important on pension values to not get focused on one number being the number, and you have to exactly match that with other assets to the penny or to the dollar, because we don't use pennies in the program. So if you want to know more about each of these mortality tables, you can click on our more information link, and this is going to give you a little bit more explanation and description of each table. And that can be very helpful in figuring out which one might be appropriate in your case. I generally use the most recent one for this purpose, for coming up with a value as a negotiating tool. Obviously, I'm not going to use the program as evidence in a contested trial of the value of the pension, but often even in contested trials, we can stipulate to some facts or some valuations, and this might be one of them. Now, the other thing is the date to evaluate the plan. So if you click on our little link here, this is the date for the discounting. If there's a later value, if you want to discount it 5 years from now, then the value will be higher because there will be less discounting, less years of not receiving the money. So we'll see as we go on. Now, the next thing we have is the curvature calculation. This will determine the marital, non-marital portion. We do not know whether somebody is going to die or not. We don't know when they're going to die, but we do know the date they started in the plan, the date they were married, and then our cutoff date of when the plan would be no longer marital. So in some states, that might be the separation date or the filing date, or it could be the date of judgment. And you may have to keep changing that date as the case drags on for another year. And of course, if the termination date is before retirement, we have a little helpful note here that what you want to do is put in the termination date as the cutoff date, because the plan is not going to grow after that. It's only going to earn interest, so to speak, or grow what's in there. But it's not going to continue to add value. So now the next question we have is the benefit amount assumes that the participant works until what date? And here you want to look at the administrator's pension benefit statement, because it could be the cutoff date, or it could be a retirement date, which is going to be the date you put in up here as the retirement date up at number 3. Okay, so you want to see how the plan is going to value it. And then this will give you the curvature fraction. So if I say that the participant here, Taylor, is going to work until their retirement date, I can check that box. And now the curvature fraction changed. Why? Because the continued work would be non-marital. And so therefore the non-marital share increases and the marital share decreases. However, the overall benefits may also be increasing. So that doesn't mean that the non-pension spouse, the out spouse, is going to get less. It just means that it's going to shift. So, but most of the time when I'm doing these, I'm looking at the cutoff date being the separation date or the date of judgment, and not looking at the continued work. But sometimes you may want to look at that for a more realistic vision if you have younger people. Okay. Now, the next item here is then the curvature fraction, and you can look at the actual calculation. I'm frozen. Why am I frozen? There we go. And this gives you the actual numerator and denominator of the curvature with the number of days. So that's helpful to double check that you have the right dates, and also to show your clients what that means, because they don't know the word curvature. Okay, some of us don't know the word curvature. So now we're going to calculate the marital amount by taking the value from line 10 and multiplying it by the curvature fraction to get the marital amount, which is the pension value and the curvature fraction multiplied by each other to get the marital portion. The next thing that the software is going to ask you for is, how is this pension going to be divided? So typically with defined benefit pensions, we're either going to divide them equally, or we're going to give it to one party or the other. It's fairly rare to divide it disproportionately only because it's not a real value that you're offsetting in some way. So you want to be careful about that, especially if, like in Illinois, state pensions have no death benefit to the former spouse. So you have to be aware of that in terms of that's not entered in as a number or value. It's not quantifiable, but it is a risk. Okay. And so now if we say we're going to divide this pension 50-50, it'll show you for each party what their value is and the non-marital or separate value equity of the plan owner, meaning in this case, Taylor. Okay. And then we have a marital and separate value amounts table that will show you what's going to go into the balance sheet. And we have an explanation here of that valuation. So this is a very simple way of understanding the marital, non-marital portions, marital and separate. Okay. So then the next thing is we would be able to know, are we doing lump sum payments? Most pensions don't. They're not going to be doing a lump sum payment. They're going to be getting a stream of payments. So we can look at those benefit payments. But in this case, if I click that, I am not going to see any payments because I'm only going out 5 years in the future in my projections. So what I can do is I can go into settings, assumptions, and I can change the number of years for cash flow and net worth projections. And I can pick any number from 1 to 50. So let's go whole hog, we'll go out 50 years. You can also get to that same data entry if you go to reports, more reports, and at the top of the page, you will see the number of years to use for projections, and you can put in the number of years there. That's on the For Lawyers page of more reports. You can also go to the planners page, and the same thing is there. Number of years to show in reports, 50. Okay, so now I'm going to go back to that pension, into more info, and now I'm going to go to 25 or section E of this page and look at the benefit payments to both parties. So we know Taylor's got a non-marital portion and the marital portion they're dividing equally. So this is what's going to look like, and there's a COLA. So every year it's going to go up. The first year is going to be a short year because they're not starting in January, they're starting later in the year. And then here's the benefit payments to Taylor. And here's the benefit payments to Blake. And you can see what that stream is. And then next week, our Web Power webinar is going to be on data assumptions and projections. And we'll show you how this flows into the projections in the software. Okay, so that is the benefit payments. And then we have some selections which you can use. Do you want it to be on the financial affidavit or not? You can check it to make it not be. Whose financial affidavit should it be listed on? Generally speaking, the default is both parties because it is an asset of the marriage, but sometimes people will only put it on the person's affidavit who owns it. And then the next thing is, do you want to include the pension value in net worth projections? And that's interesting because it will include the payments, but you want the value in net worth. So we'll talk about that more next week, but you might want to uncheck that depending on what you want to do. And now we get to the reporting and audit trail. This is great reports. So the first one is more of a client report, I don't know that it's really a client report as much as it's a simpler report. I like to use this to sort of check what my data inputs were. Is this what I wanted to do? Because it lays it out in more text-based, and it really shows you all the data entry, and this is what we're working with. And then we have a audit trail report. This is for the nerds among us who like to see all the math, or if you want to keep the other side from arguing about your valuation, you give them this so that they have to look at all the math. And this is very detailed, as you can see, with the probabilities, the mortality tables, and so on. So this is a real good way to see what that mortality table really is about. When you pick a different table, that would be different information. Okay. So now, if we get to the point of sending reports around, you can go into more reports on the planner's page, and there is the pension valuation report. It is report number 22. Sorry, I went too far. And this is also a nice report. This is the summary client one that we talked about. Okay. Now, there are other retirement accounts, IRA and 401k accounts, and I'm going to give you just a couple of minutes on those. I'm going to go, instead of into defined benefit plans, I'm in the enter data section of the menus, and I'm going to go to assets and liabilities, and I'm going to go to the IRA 401k part. And here, again, you put in the basic data, and you can put in more information. So a couple of important things. What's the current balance? So IRA 401ks, those are defined contribution plans. So that is, we need a balance, and we also want to know what the current contributions are, because that will impact taxes and potentially impact support for net income states. And here again, we're going to go into more information. And this would be for the kinds of accounts like IRAs, 401ks, Roth IRAs, Roth 401ks, and also this is a good place to put in 529 plans. So here's the thing about 529 plans. They are not taxed on the gains if they are used for school purposes. So it's after-tax money, but it goes in that way. And so you could put it in as a regular asset, or you could put it in here. So I could put it in as an investment asset, or I can put it in here, and I would mark it as a child's asset, even though technically a 529 plan is still owned by the marital estate. But most people will agree that they want that for their children. Not all. I've had some who say, no, we're going to split it. Okay, you want to put whose name it's titled in. Retirement accounts really can never be joint. They have to be in one or the other name. Again, for later information purposes, you want to say where the account is, because that'll help you make sure you have a good quadro or letter of direction if it's an IRA. And valuation date is also important, because those, again, also have fluctuating values because they're invested usually. We do have the selection of not including something on the financial affidavit. I would always err on the side of including something if there's a reason to not include it. I haven't thought of it yet. Okay, so you're going to enter the value of the account. Now, there may be loans on the account, so you want to put those in here. loans are paid from the account, they may be a monthly payment as well for paying back that loan. That would go into another issue. So we won't get into that today. If there's any separate portion of a 401 or IRA account, you can put it here. You can make it entirely separate, or you can put in the amount that's separate. Our program does not do the calculation of the marital, non-marital of a combined account. So account that was originally non-marital, that there were continuing contributions during the marriage, which part of it is of the current value is the non-marital versus the marital. You need a lot of information. We just don't do that. It's a whole separate thing that you can have somebody do for you. So if we put in a non-marital portion, that'll be taken out from the marital estate balance, and the rest will be marital. Okay. And then the same thing here is, how are you going to divide the plan? You can do it here, or you can wait and do it with all of your property division in your divide property scenario. Okay. And then we want to talk about the contributions, okay, annual or monthly or weekly. And then you can also talk about the distributions. So we can either have regular retirement distributions, or we can have early distributions. And the program knows how to ask all the right questions to be able to determine how that is going to be taxed. Is there a 10% penalty or not? And what the income tax consequence is going to be. Okay, so that is our retirement plan and pensions webinar.